Welcome to Illuminati Silver. We tell you the truth about silver. Today is Wednesday, the 14th of August, 2019, and we're looking at an article published by Peter Hahn, who is the Professor of Banking at the London Institute of Banking and Finance, the industry body for British banking, entitled Lessons in Going Global, where he discusses why Germany's largest banks have found global expansion to be so problematic, in contrast to their United States counterparts. He gives us an insight into some of Deutsche Bank's difficulties, and also why a number of banks have failed while others have succeeded. He also highlights what banks need to do in order to succeed in the future, and what they shouldn't. Let's investigate. Lessons in Going Global. Peter Hahn discusses why Germany's largest banks have found consolidation and global expansion to be so problematic, in contrast to their United States counterparts. Quote, "The lust of Eurozone commercial bankers for a single financial market of a size and scope to rival that in the United States is palpable, but unlikely to be satisfied. Even as they envy JP Morgan's market capitalization and global clout, many are retreating further behind national borders. And that is often the correct step. But there was a time when things were different. Given the ongoing speculation about the futures of Commerzbank and Deutsche Bank, it is worthwhile looking back to when US banks cast an envious eye on Europe. Once, before the introduction of the euro, European banks had size on their side. Germany has long been the biggest economy in Europe in 1970. Its GDP was $215 billion, and France, its next largest neighbour, had a GDP of $148 billion. All figures are from the World Bank and in current dollar terms. In the 1970s, what is now the European Union area had a GDP at least on a par with that of the US, depending on how the figures are translated into today's dollars, and Germany's Commerzbank had ambitions of becoming a truly pan-European bank. In the US in 1970, things looked more provincial. Banks such as Citi, First National City Bank, and JP Morgan, Chase, Chemical Bank, and Manufacturers Hanover Trust were limited to having branch offices in New York City and adjacent counties. They could not even have retail branches for weekenders on Eastern Long Island, let alone in Chicago. Commerzbank, however, formed Europartners Bank, a group including Credit Lyonnais from France, Banco di Roma from Italy, and later Banco Hispano-Americano from Spain. Those three countries represented both a large chunk of European GDP and a big slice of the non-communist map of Europe. While Commerzbank was forging a cross-border European bank, the US banks had correspondence in domestic geographies. Yes, that means in the same country. Interstate banking was largely prohibited by the 1927 McFadden Act. The competitive zest of Commerzbank may surprise those who associate German banks with a joke made by Mario Monti when he was the EU commissioner responsible for competition, that the only two German words he knew were Gewährträgerhaftung and Altstaatslast, two forms of state guarantees for German public sector banks that he saw abolished in 2002. And that did not apply to Commerzbank before its bailout. In 1970, it was US banks that felt the need for a more market-based approach. They wanted to consolidate, but even domestic efforts along the lines of Euro partners were inconceivable. Bizarrely, US banks were able to carry out certain business functions outside the country that they were banned from inside. I worked for the manufacturer's Hanover Trust Company of New York, which owned a subsidiary in London that could underwrite corporate bonds, a strict no in the US under the then Glass-Steagall Act. Having one leg in London to do business like that was commonplace for large US banks, and not very surprising as their home retail growth was so restricted. Glass-Steagall was also the reason for the development of the Eurodollar market and arguably of the City of London as a global financial centre. In general, European rules were much less restrictive. Retail banking had largely consolidated in France and in the United Kingdom, with building society demutualisation in the UK in the 1980s leading to the last big leg. Of course, US banks did make plans to acquire other banks in the United States because the potential cost efficiencies of consolidation were obvious in a largely homogeneous market, as were the revenue and product opportunities. A larger customer base can provide stimulus for product innovation and be a funding source to invest in such products. As their move into Europe shows, US banks found plenty of temporary loopholes while they waited for regulators to allow consolidation at home. For example, non-bank subsidiaries, those not funded with deposits, and credit cards could be set up nationally. The compelling economics of US consolidation and the then ugliness of Latin American economic woes concentrated US banking minds on their domestic market. With each acquisition, banks such as the National Bank of North Carolina, now known as the Bank of America after an acquisition, became better at integrating their targets, which became even bigger. Imagine an old Pac-Man game. You can actually improve your merger and acquisition skills when repeated acquisitions are in similar businesses, with similar regulations and IT. As the biggest got bigger, their international interests continued to wane, but this did not happen in Germany, Spain, or Italy at the time. Unlike the US bank consolidation after the 2008 crisis, which was about survivors buying the desperate, most of the consolidation in prior decades saw relatively strong banks getting stronger, gaining customers, shedding fixed expense, and adding expertise. It did not always work, and it took place at the time as a substantial proportion of the US mutual banking sector failed. But those mutuals were not rescued. They were liquidated or absorbed. In Germany, Spain, and Italy, such institutions lived on through the late 1970s to the 1990s, which meant that those markets were very fragmented. During the heady days of US consolidation, the arriving winners, that is, Wells Fargo, Bank of America, Wachovia, and now Wells, among others, focused on growing in a big and largely homogeneous domestic market, and left more splintered international business to others. In Europe in the 1970s and 80s, the Euro Partners Group chased international ambitions. It wanted to allow retail customers from one country to access the branches of the others. It also wanted to combine investment banking across the then European Economic Community. Remember, this was long before the euro was conceived. Its ambition had to vault over different currencies, regulations, laws, for example on insolvency, and huge cultural differences. At the same time, the group missed out on much of the domestic opportunity for efficiency and more manageable risk consolidation strategies that the US banks sought. The Euro partners took equity participations in each other, some as high as 10%, which conjures up fears about contagion. Who owns 10% of any major national bank today? It was certainly risk-taking without control. Control is what matters in M&A, mergers and acquisitions. Although the cross-holdings were large and in substantial banks, the much vaunted cooperation did not seem to go much further than branding. Students might be forgiven for thinking Europartners died because of burdensome regulation or meddling politicians. Today's real or imagined bogeyman of European bank consolidation. But although there were such barriers, it was mostly about bad banking decisions, distrust, and national obstinacy at each constituent bank. The unravelling started before they got very far. The French and German banks had a Spanish partner, but were also keen on having their own offices in Spain. Could you be a partner and competitor? Many European national authorities were also not keen on foreign ownership of a major domestic bank, which must have further strained trust. Then came the scandal and bailout that undermined Credit Lyonnais in the early 1990s. But looking abroad for growth was in style at large German banks, if only because they all faced the same problem: a highly fragmented market with many state-sponsored players. The other two big players, Deutsche Bank and Dresdner Bank, took a different tack to Commerzbank. They went on buying sprees well beyond their expertise or principal domicile, and they often bought perceived second-tier overseas businesses in which they had limited background and that they stood little chance of integrating well. Deutsche Bank's London investment bank was built off a £950 million, worth £2.5 billion today, purchase of a weakened Morgan Grenfell in 1989. Morgan Grenfell had already sold off its securities trading business, leaving no overlap between the two banks, which was expected to make them, quote, an excellent fit, unquote. Deutsche's US investment bank was largely built on the $9.2 billion, $16 billion today, purchase of a former US custodial or trust bank that had been trying to become an investment bank, Bankers Trust, in 1998. At the time, it was the largest ever acquisition of a US bank by a foreign firm, and Bankers Trust was available partly because of a scandal around interest rate derivatives in 1994. To be fair, US banks also bought second-tier banks overseas with limited success, but they were toes in the water in comparison with Deutsche's deals. US domestic consolidation also brought benefits that eluded European banks. In 1996, for example, Chemical Bank bought Chase for $10 billion. But it expected to reduce costs by $1.5 billion per annum and shed almost 15% of staff, while retaining the combined customer revenue base. Deutsche's deals offered none of the above. Instead, they generated a legacy of high costs that has haunted Deutsche's wholesale business for decades. Deutsche's neighbour in Frankfurt, Dresdner Bank, suffered a similar fate. In 2000, when it was Germany's third biggest bank, it bought London's Kleinwort Benson and New York's Wasserstein Perella, or WP. WP cost $1.4 billion, worth $4 billion today, and was a 600-person advisory boutique. Its assets were its people. But Bruce Wasserstein, the big gun at the firm, left in 2002. What does the future hold for German banking, M&A, and for big German banks? There has to be domestic consolidation to create a more efficient system, but not at the top. It has to come at the bottom. A merger of Commerzbank and Deutsche Bank, Germany's two largest international banks, which was discussed and then rejected earlier this year, might reduce costs if it could be managed, but it would also reduce international skills rather than boost systemic efficiency. Good banking M&A would mean consolidation among Germany's vast mutual and public providers. That holds the promise of reducing overheads and redirecting funds for expanded services, but it will not happen without incentives and legal facilitation. Demutualization could be a start, but mutuals might also lead with capital innovation. The digital age will wear down the economics of small banks in Germany and reduce the cultural differences of consumer banking across Europe. It is also likely to make the Euro partners' ambition a reality. But in the near to medium term, most of the Eurozone banking challenge remains building stronger, more productive, diversified, and skilled domestic banks. Only then can European banks think about uniting for the transatlantic challenge they clamour for. Eurozone regulators will have to grapple with a changed, too big to fail challenge, but one that is inevitable." Unquote. Peter's article on banking strategy is, to be fair, very accurate. Admittedly, he does not address the misdeeds or illegalities some of these banks have committed, especially Deutsche Bank. But then that was not the purpose of his article. He also fails to cover some of the wider competition banks face. We have produced within the Inner Sanctum a number of videos on this subject, the two most recent of which are entitled Disruption in Financial Services and Getting to the Ground Truth, Why Banks Fear Internet Giants. These address serious competitive threats from retail and tech giants interested in either entering or expanding financial services operations. And these will provide an ever-changing marketplace in terms of where consumers obtain their loans and place their deposits. Our view is that we foresee some major acquisitions and mergers between retail giants and the banking sectors. And where regulators have, in the past, stepped in the way, with deregulation being in vogue, and especially within the United States, such obstructions will become fewer. The banking industry as we know it is not only undergoing major change, but to some extent a major change in identity. And this will provide new challenges as we move ever closer towards a digital, cashless society. What do you think? Do share your thoughts. And before we close, we would also like to thank all of our subscribers and supporters who have helped us to reach 15,000 YouTube subscribers. And yesterday we published a video providing details of how you may receive a gift to celebrate. We've provided links to that video in the description below. We hope you have found this video interesting and informative, and if so, please give it a thumbs up and share it on social media. Please ensure that you have subscribed to our channel and press the bell sign so that you are notified of any future videos. Also, kindly visit our website at illuminatisilver.com, and if you haven't already done so, please subscribe either as a free or paying member for regular email updates and offers. Disclaimer: Illuminati Silver owners come from a background of banking, international wealth management and economics. Having now retired from these worlds, we are not qualified to give investment advice. Therefore, this and other productions must not be deemed to be giving such advice and merely represent the personal views of its owners.